international equity markets. We believe that in your firm, we should invest in our portfolio or diversify our portfolio into international markets such as Asia, Latin America, and Europe. And by doing so, we diversify our portfolio, and then we also can branch out to local investors, and this will increase our stock price and also expand our company itself.
Well, we could do this by taking advantage of rising interest rates globally, such as in the UK, as well as assumptions or forecasts of rising currency in the pound. In buying bonds, we could expect a solid return on top of the appreciation of the pound against the dollar. A statistical perspective of the entire international economy or market is kind of based off of maybe like 31 developed countries, because these 31 developed countries pretty much are accounted for 75% of like market capitalization, which is in total 54 billion. And these countries do a lot of transactions, and because of all these transactions that they do, they create a thing called liquidity. And liquidity is just the availability to make a trade or to take your money out of a certain type of market because of the volume of trades. Basically, the more concentrated or kind of underdeveloped a market is, the less amount of trades there are, and the more kind of volatility you see based on those big companies in these small markets.
Okay, so here we have some market structure, trading practices, and costs. So secondary equity markets serve two main purposes. It's marketability and share valuation. And underneath that is secondary markets allow share owners to reduce their holdings in unwanted shares. The broker's purpose in the market structure is to represent the public buyer and seller. They submit either market orders or limit orders. And the difference between a market order and a limit order is a market order is executed at the best available price, whereas a limited order is held until it can be executed at a desired price. So continuing on that, so an OTC is a dealer market, and it's over-the-counter trades. So you guys all know what the NASDAQ is, just a computer-linked security system that shows asking bid prices. They have specialists on the floor that represent each stock being traded. So continuous markets, OTC and the exchange markets in the U.S. are continuous markets, which means that they can be executed at any time. Whereas call markets and crowd trading take place in places like the Paris, the Zurich, and the Madrid markets, where orders are not executed right away. And the downside is you don't get the exact price, so you don't know exactly what price you're buying at.
So trading in international equities. So since 1980s, world capital markets have been basically expanding, and people are investing more and globally. So that's because people are just realizing the importance of portfolio diversification, and then also multinational corporations are realizing the benefits of international capital and expanding globally to local investors. And so cross-listing is when you have a firm and then they have their equity shares in one or more foreign exchanges. And basically this establishes, like what I said before, like a better investor base for this firm's stock. And then and it just establishes a better name, reputation, and recognition for the firm. And bonding theory is basically the U.S. cross-listing. It basically restricts corporate insiders from benefiting from consuming private benefits and public benefits. And then Yankee stock is it's named that through Latin American companies when they listed their stock on U.S. exchanges. And basically ADRs, so kind of going back, so these kind of stocks are not traded as stocks, but rather as receipts. And these are called ADRs, American Depository Receipts. receipts, and if they're traded on Singaporean markets, then they're called SDRs, and so on and so forth. So basically, the ADR is the number of foreign shares that remain on deposit with the U.S. depository custodian in the U.S. issuer's home market, and then a sponsored ADR is when it's created by a bank from the foreign company, and then an unsponsored ADR is when it's coming from a U.S. investment banking firm. And then non-American investors invest in ADRs because there's no need for currency conversion. So if you get, so it's already put into a U.S. currency rather than a foreign currency, and then you would have to like exchange it. And then there are also dividends, which are in U.S. dollars rather than that foreign currency.
So international equity market benchmarks, so this is where we get into what we're talking about, diversifying, going global. So MSCI is a database, and they construct and publish national stock performances, provides price level data and returns for 24 national stock markets. The website also provides a weighted world stock index collected from 2,600 stock issues. And MSCI iShares is a basket of stocks designed to replicate various MSCI stock indexes. These stocks are subject to follow the U.S., SEC, and IRS diversification requirements. And so if we go down here, it talks about how iShares are a great way to buy low cost and easy stocks. So it's good for us who are trying to go globally. It makes it easy, and it also it follows the requirements of the SEC and the IRS. And it says that the requirements are that 50% of the fund cannot be in 50% of the fund has to be in 5 or fewer securities, and 25% of the fund in a single security. So those are the requirements that it fits in. So yeah, like I said, it's a great way for us to get into the global market. It's easy and it's low.
Some of the factors, these are kind of like old tests or things that these economists found back in the day. They basically found that international monetary variables have a weak influence on equity returns over there for people who live over there, as well as changes in international production, employment, imports, and the level of interest rates had a little correlation for some of those equity returns in 10 of the biggest European markets. So they found out all these things that international markets are not very correlated with each other. There's a lot more variables because of the amount of countries that they have and the different interest rates and currencies that they just all got going on. So basically, we have a client here that has a $8 trillion account, and they have an illness in the family that they don't really want to focus on finance. So what they want us to do is they want us to take the money and get them at least 5% a year without any worries at all. So our plan is to diversify our portfolio by investing in international bonds and currencies, by then taking advantage of the appreciation of the desired currency and then bringing it back over. And our plan is to go into a liquid market such as China or the UK, because if this family member ever gets sick or needs treatment for some type of service, we will be able to convert it back into dollars to fit their needs.
Before you go, you need to wrap it up at the end and pitch what you pitched at the very beginning, which is, here's the opportunity. We identified a global portfolio of equities that we believe we can construct a global portfolio. We also believe that we can raise $20 billion in assets under management in a 1 to 3 year period. We believe that we can get a 1 point on the assets under management fees and be able to generate $200 million in the 3 to 5 years that we're managing the portfolio. Okay, so it's got to be a pitch. And if you do a good job, of constructing the portfolio, it's not going to be one client. We're going to be able to roll it out, and we're raising a fund. Okay, so our company isn't really investing in this portfolio. We may co-invest. so there's an alignment of interest. But we don't have $20 billion. We're gonna raise a $20 billion fund. And then if we're good at it, we're gonna raise another $20 billion fund. Maybe we'll do a active managed fund. Maybe we'll do a smart beta fund. Maybe we'll do an indexed fund. If we do a good job, maybe we can create exchange traded funds under the GTC brand and build out a whole offering of institutional and retail product that we can bring our investors, but also expand our investor base. So you need to start thinking about innovation, and product innovation, and start thinking about business, and how you're going to commercialize these concepts into a business standpoint. Okay, so, and for those of you who are presenting on Wednesday and Friday, you need to come in. It's got to be a GTC branded recommendation or fund. You got to have an economics page on the first and the last, and it's got to have numbers in it. Okay, as though you're presenting to the investment committee. Okay. Okay, so start moving in that direction. All right. Okay. Nice.